Hello and welcome. Thank you for making time to be here today. My name is Dr. Glory Eninaya, founder of Cleos Advisory Africa, and over the next hour, I want to share with you a framework that grew out of several years of doctoral research into one of the most urgent puzzles in African enterprise. The title of today's session is Institutional Growth, and the central idea is contained in this subtitle, a shift from investor readiness to change readiness. I want to make a promise to you at the very start. By the end of this hour, you will not look at a pitch deck, an accelerator, or a funding round the same way again, because we're going to question the single most celebrated assumption in our ecosystem, which is the belief that raising capital is the proof that a venture is ready to win. Let me show you why that assumption is quietly killing some of our most promising companies and what to build instead. Let's begin. Before we dive in, here is the map for our time together today. First, I'll lay out the promise and the paradox, the extraordinary growth of African startups sitting right alongside an uncomfortable survival crisis. Second, I'll offer the reframe at the heart of my research, a move from investor readiness to change readiness, built on the insights that in our markets, legitimacy, not capital, is the true currency of survival. Third, we'll unpack the three C's: customer orientation, collectivism, and commitment to impact. These are the three capacities that separate ventures that endure from ventures that simply raise. Fourth, I'll walk you through what I call the seven provocations, seven concrete shifts that translate this thinking into practice. And finally, we'll get practical, a diagnostic you can apply to your own venture, and a fresh lens for those of you who teach, invest, or make policy. I'll hold questions to the end, so jot them down as we go. Let's start with the story everyone already knows, the boom. Let's begin with the good news because it is genuinely good. Over the past decade, from Lagos to Nairobi, startups have transformed how Africans live, pay, save, lend, and build businesses. The numbers are striking. Between 2020 and 2021, African startup funding grew by more than 200% at a time when global funding grew by 90%. And fintech captured roughly half of that surge. Out of this momentum, we produced household names: Flutterwave, Chipper Cash, MNT Harlan, unicorns that proved Africa can build globally competitive ventures. And this is not only an investor story. The World Bank credits mobile money with narrowing the gender gap in financial inclusion, giving millions of women their first formal financial account. The IMF points to faster transactions and better governance. So Africa has been cast, rightly, as a laboratory of leapfrog innovation, a place where digital finance fills the gaps that infrastructure left behind. Hold on to that picture of promise, because in the very next breath, the data tells a far more sobering story. Here's the paradox. Despite record-breaking capital, many of our ventures collapse within a few years of launch. Beneath the celebrated valuations lies a persistent pattern of early collapse, strategic drift, and stalled scaling. Look at the chart. The Boston Consulting Group found that African startups rarely survive beyond Series B, delivering average venture returns of less than 3%. Compare that to roughly 11% in Asia Pacific and nearly 16% in Europe. And these are not abstract figures. Okra, a Nigerian open banking fintech, raised $16 million and shut down in 2025, undone by regulatory battles and governance breakdown. Zazu, a remittance platform, closed in 2023 even after raising $2 million, citing crushing compliance costs and fragmented infrastructure. LaserPay folded after failed acquisition talks and founder burnout. Now, the easy explanation is that these were just bad bets, but I want to suggest something deeper. These were not failures of ambition or even of capital. They were failures of faith, a systemic misalignment between ventures and the institutional environments they were trying to serve. And that points us to a different definition of what readiness actually means. So here is the sentence I want you to carry out of this room today. In Africa's institutional reality, legitimacy, not capital, is the currency of survival. Let me unpack what that means. Across our accelerators and venture pipelines, founders are trained to do three things brilliantly: master the pitch deck, demonstrate a vast total addressable market, and show a polished minimum viable product. This whole doctrine treats external investment as the ultimate validation of quality. But here's the problem. A firm can be perfectly optimized for investor readiness and still fail the moment it meets Africa's institutional complexity. It can look fundable and yet lack the institutional fitness to earn trust among regulators, among users, among the communities it claims to serve. The scholar Mark Suckman reminds us that legitimacy is a generalized perception that an organization's actions are seen as desirable, proper, and appropriate within a community's shared norms and values. Investor readiness is conferred from the outside through capital. Legitimacy is earned through alignment, and that is precisely the thing capital cannot buy, which brings us to the framework itself. Let me put the two paradigms side by side because the contrast is the whole argument. On the left, investor readiness. It is conferred from the outside through capital. Its tools are the pitch deck, the total addressable market, the polished minimum viable product. It signals growth potential. It is optimized for fundability. And, as we've just seen, it is dangerously vulnerable when the institutional ground shifts. On the right, change readiness. It is not conferred, it is earned through alignment with the expectations of users, regulators, partners, and society. Its substance is legitimacy, resilience, and alignment. It demonstrates not just the potential to grow, but the right to operate. And because it is anchored to enduring values, it endures turbulence rather than being broken by it. Notice the shift in the verb. Investor readiness is about raising funds. Change readiness is about raising trust. Now, I'm not telling you capital does not matter. Of course it does. I'm telling you that capital without legitimacy is a building with no foundation. It can rise quickly and it can fall just as fast. So let's define change readiness precisely and then build it piece by piece. Here is the definition I want us to work from. Change readiness is the capacity to navigate turbulence while remaining anchored to enduring values. In one phrase, the pursuit of institutional faith. It reframes survival as a function of faith rather than of financial signals. It shifts our attention from raising funds to raising trust, from demonstrating growth potential to demonstrating legitimacy. And it rests on three pillars. The first is legitimacy, acceptance that has to be won across three domains, which I'll come to in a moment. The second is resilience, the strength to endure shocks, including the funding winters that periodically freeze our ecosystem. And the third is alignment, coherence with the social, political, and cultural context you actually operate in, not the one a Silicon Valley playbook assumes. When a venture holds all three, something important happens. The founder stops being merely an opportunity seeker and becomes an institutional actor, someone who doesn't just exploit a gap in the market, but helps shape the institutions around it. Of those three pillars, legitimacy is the one we most often misunderstand. So let me slow down and give it the attention it deserves. Within institutional theory, legitimacy is the central determinant of survival. And the cleanest definition comes from Mark Suchman, who describes it as a generalized perception that an organization's actions are desirable, proper, or appropriate within a socially constructed system of norms, values, and beliefs. Read that again slowly because every word matters. It's a perception. It lives in the minds of your stakeholders, not on your balance sheet. It is generalized. It has to be shared widely, not held by a single champion. And it's about being seen as appropriate within a community's values. Here's the crucial contrast. Investor readiness is externally conferred. Someone with capital decides you're worthy and writes a check. It's a signal. Legitimacy is different in kind. It cannot be written into your account. It is earned slowly, relationally, through alignment with the people whose acceptance you actually need. Your users, your regulators, your partners, and the society around you. And legitimacy is not one thing. Scholars identify three distinct dimensions, and African startups need all three at once. Let me show you what they are. Legitimacy comes in three forms, and a venture needs all of them at the same time. The first is cognitive legitimacy. The question it answers is simple. Does this make sense? Does the venture fit the existing cultural and mental models of the people it serves? In Africa, many technically sound business models fail here. They are culturally illegible. M-Pesa succeeded precisely because it embedded trust and familiarity into its design. So a first-time user understood it immediately. The second is pragmatic legitimacy. The question here is, does it deliver value? This one is grounded in performance. Stakeholders confer it when they see tangible, credible results. TimeBank in South Africa is the model. It built trust through transparent savings tools and outcome-verified marketing, proving practical utility rather than promising it. The third is moral legitimacy. The question, is it right? This is judged on fairness, ethics, and social responsibility. Jamoo in Côte d'Ivoire exemplified it by choosing cooperative partnerships with incumbents over confrontation, and in doing so, earned the trust of regulators. By contrast, firms that engage in impact washing or exploitative lending lose moral legitimacy, regardless of how strong their financials look. Cognitive, pragmatic, and moral. Make sense, deliver value, do right. Hold these three questions in your mind because the entire framework I'm about to give you is really just a disciplined way of answering them. And those answers cluster into three capacities. I'll call them the 3 C's. When I analyzed my interviews, the case studies, and the industry reports, a clear pattern emerged. The African ventures that survived and scaled did so not because they were the best capitalized or the most technically advanced, but because they had mastered a deeper set of institutional competencies. I distilled those into three interrelated capacities, the 3 C's of change readiness. The first is customer orientation. This is the rational imperative, making sense to your users by anchoring your model in their logics, their trust, their culture. In classical terms, this is logos. The second is collectivism. This is the relational imperative, the recognition that in our markets, ventures endure not through individual brilliance, but through coalitions and belonging. This is pathos, institutional resonance. The third is commitment to impact. This is the ethical imperative, doing what is right and sustainable, and proving viability through tangible outcomes rather than promises. This is ethos in action. Logos, pathos, ethos. Reason, belonging, integrity. Together, they define what it means to be change ready. Now, let me take each one in turn and show you the concrete practices that bring it to life, beginning with the most foundational of the three, customer orientation. We begin with customer orientation, the most foundational of the three capacities. Here is why it comes first. In volatile contexts where formal institutions are weak and trust is scarce, you cannot assume that markets are pre-given or that a good product will simply find acceptance. You have to earn it. That means anchoring your model in your users' own logics, building trust through everyday interactions, and aligning your brand with cultural expectations. In my interviews, the founders who invested in listening through community engagement, iterative pilots, culturally resonant messaging were far more likely to achieve legitimacy and retention. The ones who imposed externally derived business models, often designed for investor appeal rather than user faith, experienced rapid churn. Customer orientation expresses itself through these practices. Let me show you all three. The first practice is values-based opportunity recognition. In African fintech or the startup landscape, opportunity is not simply about identifying a large market gap. It requires asking whether the opportunity aligns with local values, norms, and daily realities. M-Pesa's success in Kenya was not about inventing mobile payments. It was about recognizing the deeply embedded cultural practice of sending money home to rural relatives. Money Fellows in Egypt did the same, taking the familiar Rosca, the rotating savings group your grandmother might have run, and putting it on a phone so users understood it instantly. The second practice is trust-centered product development. In markets that are skeptical of formal finance, your product must lead with simplicity, transparency, and trust, not speed. Paga in Nigeria is the example. Rather than going purely digital, it built an extensive network of human agents, face-to-face trust brokers who reassured customers that were wary of screens. Technology plus a human face, scalable and culturally legible at once. The third practice is performance-driven brand identity. In volatile markets, your brand cannot rest on aspirational imagery. Customers judge you by whether their money arrives on time, whether disputes are resolved fairly, whether the system is there when they need it. Flutterwave earned its early reputation not merely from a sleek logo, but from reliably processing transactions for merchants across borders. Performance itself became the brand. 3 practices, 1 capacity, turning abstract opportunity into real institutional legitimacy. Our second capacity is collectivism. There's a powerful myth in global startup culture, the heroic founder, the lone genius who wills a company into existence. In African startups, that myth is not just inaccurate, it is dangerous. The founders I interviewed were emphatic. Ventures endure not through individual brilliance, but through collective alignment. They described navigating complex webs of regulators, banks, telcos, and community actors. The ventures that isolated themselves, whether out of hubris or fear, were quickly marginalized. The ones that built coalitions survived shocks and even shaped the institutional environment in their favor. Collectivism shows up in 2 dimensions: internal cohesion, which is how you build your team, and external alliances, which is how you build your partnerships. Let me show you the two practices that express it. Collectivism expresses itself through two practices. The fourth practice overall is culture-grounded team building. Internally, collectivism means building teams that embody cultural fits and shared values. One founder I interviewed put it beautifully. Technical skills may matter, but in this market, trust within the team is just as important as trust outside it. Andela is the exemplar. By recruiting and training African software engineers within a culture of excellence and collaboration, it built legitimacy with local talent and global clients alike. The internal posture became an external asset. The fifth practice is outcome verified marketing. In fragile ecosystems, marketing claims are met with skepticism. People who have been promised too much too often. So you must prove your impact with data, testimonials, and verifiable outcomes. Time Bank again leads here. Instead of making vague promises about inclusion, it tracked millions of new accounts and demonstrated that it cost less to acquire a customer than its competitors did. That outcome-based proof built credibility with regulators and users at the same time. Notice what collectivism does. It expands legitimacy outwards, from the individual venture to the whole ecosystem. Firms that align themselves with the collective interests of their employees and customers come to be seen as legitimate institutional actors. And that brings us to the third and final capacity. Our third capacity is commitment to impact. Let me be precise about what I mean, because the word impact is badly overused. I'm not talking about impact washing, the glossy slide about social good that has no substance behind it. I'm talking about disciplined execution that proves viability through tangible outcomes. The ventures that survived did not rely on funding alone. They demonstrated break-even potential, they controlled costs, and they built trust by showing that their services created measurable value. This mattered most when capital got scarce. During the funding scarcity of 2023, when inflows slowed across the continent, the ventures that could sustain operations from their own revenues were far more likely to endure. My interviewees came back again and again to unit economics, operational efficiency, and customer retention as the real markers of credibility. Two practices articulate this capacity. Let me walk you through them. The sixth practice is legitimacy-led partnership. With African startups, survival often depends on alliances that embed you within the broader institutional system. Firms that cultivate trust with banks, regulators, and global networks earn the credibility to operate at scale. Flutterwave is the clearest example. It built partnerships that transformed it from a startup into indispensable payments infrastructure. By contrast, ventures that tried to disrupt without building coalitions ran straight into regulatory pushback and market exclusion. The seventh and final practice is conscientious growth. This is the discipline of scaling only when your processes, your governance, and your legitimacy are firmly in place. Many African ventures falter precisely because they pursue rapid expansion on weak foundations. Jamo did it right. It deliberately consolidated in Côte d'Ivoire before expanding into the wider region. And Money Fellows earned trust by making disputes easy to resolve. Laserpay did it wrong. Its premature scaling without regulatory alignment is a cautionary tale of growth unsupported by institutional readiness. So that is the full set. 3 capacities, 7 practices. But I promised you provocations, sharp, memorable contrasts that you can carry into your own work. Let me give you those now because this is where the framework really bites. Here on one slide are the 7 provocations. Each one takes a piece of imported startup orthodoxy and turns it on its head for the African context. In opportunity recognition, we move from TAM, total addressable market, to TAV, total addressable void. From how big is the prize to what fracture are we called to heal. In products, from MVP, minimum viable product, to MTP, minimum trustworthy product. In brand, from message to proof. Your reputation is not what you say, it is what you reliably do. In team, from fit to posture. Cultural coherence beats raw talent. In marketing, from channel to trust. If the messenger isn't trusted, neither is the message. In partnerships, from value to values. The best partnerships are invited, not chased. And in growth, from blitz scaling to belonging. Misaligned scale doesn't fix problems, it multiplies them. Don't worry about memorizing all 7 at once. I'm going to take you through them in 2 passes with the stories behind each. Let's start with the first 4. Let's go deeper on the first 4. From TAM to TAV. For decades, founders have been coached to calculate their total addressable market and present a $1 billion projection as proof of viability. A big market equals a big opportunity. But Africa's history exposes the flaw. Lydia, a Nigerian lending platform, entered a vast SME credit market and still collapsed because it never earned the social license to operate. The market was huge, but the trust was absent. So instead of total addressable market, discern your total addressable void. Don't just ask how big is the opportunity. Ask what fracture, what absence are we actually called to address. Find the fracture, not just the fortune. Second, from MVP to MTP. The Lean Startup Gospel says, build a minimum viable product, launch fast, iterate. But in low trust markets, speed isn't the constraint, credibility is. Paga's early wallet was perfectly viable, yet adoption crawled because people hesitated to trust money to an unproven system. The answer is a minimum trustworthy product, built for trust from day one. Simplicity builds confidence, and confidence drives compliance. From message to proof is the third provocation. Globally, branding is storytelling. Craft a narrative and they'll follow. But in fragile markets, your brand is not what you say, it's what you consistently do. Time Bank earned its reputation through consistent delivery and partnerships with trusted community institutions, including churches. In a low-trust market, consistency is the new charisma. And the fourth provocation is from fit to posture. Silicon Valley preaches hire smart, fire fast, talent density above all. But intellectual brilliance without cultural coherence creates dysfunction. Be Mobile Africa hired for cultural posture, people whose values aligned with the mission, even ahead of dazzling resumes. Better to be consistent than brilliant. Now we move to the final 3. The final 3 provocations move us from persuasion to belonging, from channel to trust. The digital first playbook, borrowed from global e-commerce, optimizes for cost per click. But in Africa, the credibility of the messenger usually matters more than the message. Jumia learned this the hard way. Facebook and Google ads fell flat in markets where users mistrusted unfamiliar digital offers. So it pivoted to radio and newspapers, legacy channels that carried social legitimacy. Here's the lesson. If the messenger isn't trusted, neither is the message. Now we move from value to values. Founders are taught that partnerships are won by pitching a value proposition. show the return on investment, and they'll sign. But M-Pesa did not win Safaricom by pitching value. It won by embodying values aligned with Safaricom's own identity and mission. Legitimacy attracted partners faster than any pitch deck could. The shift is profound, from pitching value to embodying values. The best partnerships are invited, not chased. And finally, from blitzscaling to belonging. The Silicon Valley mantra is grow fast and fix later. Assume scale itself will solve your problems. But in Africa, premature scale multiplies your misalignments. BeMobile Africa turned down early venture money rather than scale faster than its legitimacy could support. LaserPay did the opposite and collapsed. The reason is sobering and simple. Scaling does not correct misalignment, it multiplies it. Step back, and a single pattern emerges across all 7 provocations. Let me name it. The 7 practice shifts are not 7 unrelated tactics. They cluster around the 3 deeper capacities, the 3 C's, and seeing how they connect is the heart of the whole framework. Opportunity recognition, product development, and brand identity all point to customer orientation, the imperative of making sense to users. When ventures shift from TAM to TAV, from MVP to MTP, from message to proof, they're showing that logos here is not abstract logic, but cultural reasoning. Credibility flows from designing for how people actually think, act, and trust. Secondly, team building and marketing point to collectivism, the imperative of belonging. Shifting from fit to posture and from channel to trust shows that ventures survive when they evoke loyalty internally and legitimacy externally. This is pathos, not sentiment, but institutional resonance, the capacity to integrate into the community you aim to serve. And finally, partnerships and growth point to commitment to impact, the ethical imperative. Moving from value to values and from blitzscaling to belonging is ethos in action. Legitimacy here rests not on promises, but on procedural fairness, transparency, and disciplined stewardship. So here is why investor readiness is simply insufficient. Ventures don't fail because their markets are too small or their products too simple. They fail because they lack legitimacy. And the firms that embody logos, pathos, and ethos together become trusted institutional actors. What gives me confidence in it is that it holds across the whole continent. One of the things that gives this framework its strength is that it was validated across very different African contexts, not drawn from a single market and overgeneralized. In North Africa, Money Fellows took the culturally familiar Rosca and built a digital platform around it, a clean illustration of value-based opportunity recognition and cognitive legitimacy. In East Africa, M-Pesa's trust-centered product design demonstrated the raw power of customer orientation. In West Africa, Paga's agent-based trust model and Flutterwave's partnership-driven growth showed customer orientation and collectivism working together. And in Southern Africa, TimeBank's outcome-verified marketing and disciplined scaling reflected commitment to impact in action. These practices take different forms in different places. A Rosca in Cairo looks different from an agent network in Lagos, but the underlying capacities are universal across African fintech. That cross-regional consistency is what tells me we're looking at something structural and not anecdotal. So let's bring this home. What does change readiness actually ask of you, whether you're a founder, an investor, an educator, an operator, or a regulator? Let me get practical. If you take one practical tool from today, let it be this. Whether you're building a venture or evaluating one, Here are 4 questions that a genuinely change-ready company can answer with evidence and not assertions. First, does the venture demonstrate cultural resonance with its users? Not a slick interface, real evidence that it fits how people actually live and interact. Second, are its growth strategies aligned with its operational capacity, or is it scaling faster than its systems and governance can bear? Third, does it maintain trust with regulators and ecosystem partners? Is it inviting partnership or fighting battles it could have avoided? Fourth, has it institutionalized processes for fair customer experience? Are disputes resolved fairly and predictably, or only when someone complains loudly enough? Founders, use this as a mirror. They will tell you where you are over-optimizing for investor signals and neglecting institutional faith. Investors, use them as due diligence. Current practice prioritizes financial projections, market size, and growth potential, and overlooks the very capacities that determine survival. And here is the part that should interest the capital allocators in the room. Legitimacy-centered due diligence does not just help entrepreneurs. By reducing portfolio fragility, it also improves investor returns. Therefore, doing right and doing well are not in tension here, which means the whole ecosystem has to rethink what it rewards. Change readiness is not only a founder's discipline, it asks something of every actor in the ecosystem. Take educators first, and I say this as one. Our business schools have largely imported entrepreneurial education from Silicon Valley, lean startups, minimum viable products, fundraising strategy. These tools have value, but that they are insufficient where institutional complexity dominates. We must teach legitimacy as a strategic asset, how to conduct cultural analysis, build trust with regulators, design ethical growth, mark stakeholders, run legitimacy diagnostics, and study real cases of institutional navigation. Pedagogy has to go beyond the financial model. Then, for investors and development finance institutions, current due diligence prices projections, market size, and growth potential, and misses the institutional capacities that actually determine survival. Recalibrate the criteria to include the 3 C's and change what you celebrate, not the number of ventures funded or jobs announced, but survival rates and legitimacy milestones over time. Next, policymakers. Regulators tend to swing between laissez-faire enthusiasm and heavy-handed crackdowns. A legitimacy lens offers a wiser middle path. Regulatory sandboxes should test not only technical compliance, but also how well a venture protects customers, resolves disputes, and behaves ethically. Finally, ecosystem builders, hubs, accelerators, and associations. You should actively reward collaboration over pure competition because the sector that builds legitimacy together is stronger than one that cannibalizes itself. When teaching, funding, and support all shift in this direction, we change the trajectory of the whole sector. Let me close with what is at stake. Before I close, let me widen the lens because although this work is grounded in African fintech, the insight is not parochial. Emerging markets across Asia, Latin America, and the Middle East share the very same conditions that shaped this framework. Weak formal institutions, deep cultural heterogeneity, and fragile environments of trust. In all of them, investor readiness alone will be just as insufficient as it is here. And the framework is not confined to fintech. Wherever legitimacy is the scarce currency, in health tech, in edtech, agri-tech, the same logic applies. The sector may change, but the institutional reality does not. So the change readiness lens contributes to a broader global rethinking of entrepreneurship, one that takes institutional voice seriously and builds context-sensitive theory and practice. By articulating a model grounded in African realities, we offer something of value to ventures operating in volatile environments anywhere in the world. Wherever institutions are fragile, the deeper test is the same. Not can you raise, but can you earn the right to last? Let me leave you with that thought. Let me end where I began, with the paradox. The story of African fintech and startups is a story of billion-dollar valuations coexisting with fragile survival, of entrepreneurs celebrated as disruptors, yet struggling to become trusted institutions. Everything I've shared today has argued for one shift in the lens. Investor readiness may attract attention, but it does not ensure survival. On the other hand, change readiness, anchored in customer orientation, collectivism, and commitment to impact, is the true foundation of entrepreneurial endurance. And here is the line I most want to leave with you. In the future we are trying to build, the true measure of readiness will not be the ability to raise capital, it will be the ability to sustain legitimacy. The call then is clear, and it falls on all of us. Scholars must refine theory to account for institutional fitness. Educators must teach legitimacy as a strategic asset. Investors must evaluate ventures on resilience, not just valuation. Policymakers must support the slow and unglamorous work of legitimacy building. And founders, you must embrace the deeper work of earning trust, embedding values, and building ecosystems. If those shifts happen, African entrepreneurship can move beyond the cycle of boom and bust towards a future of enduring institutions. Ventures that master these capacities don't merely survive, they become institutional actors capable of shaping the future of African entrepreneurship. Thank you for listening. Thanks once more for spending this time with me. I genuinely welcome your hardest questions because that is where the framework gets tested and sharpened. As you take your leave, a few prompts to ponder. Where in your own venture are you optimizing for investor signals at the expense of institutional faith? Which of the three capacities, customer orientation, collectivism, and commitment to impact, is your venture strongest in? And which is the gap? And for the investors, what would it take for your due diligence to weigh legitimacy as seriously as it weighs market size? If you'd like to continue this conversation beyond today, whether that's diagnostic work with your venture, a session with your team, or designing a change readiness curriculum for your program, Cleos Advisory Africa is where that work happens, and I'd be glad to connect.